All right, let's dive into what happened in the market on December 11th, 2025. It was a really fascinating day, a real tale of two markets. You had this huge tug of war going on between two massive forces. On one side, a big reality check for the whole AI boom, and on the other, you had the Fed stepping in with a safety net.
So that sets up the big mystery for the day, right? How on earth did the broader market, I'm talking the S&P and the Dow, actually hit all-time highs while the tech sector, which has been the darling of the market for so long, stumbled and finished in the red? What was going on here?
And I mean, you can see it right here in the numbers. The S&P 500, it squeaked up to a brand new record. The Dow, man, it had an incredible day, up over 1.3% to its own all-time high. But then you look at the Nasdaq, the home of all that big tech, and it's down 0.25%. It's a perfect picture of weakness right in the middle of all that strength.
Okay, so let's tackle the first piece of this puzzle, the AI reality check. This was the big, heavy anchor that was dragging the tech sector down.
And you know what the trigger was? You can literally point to one single thing: a really, really shocking earnings report from the tech giant Oracle. Seriously, this thing landed like a lead balloon and just confirmed all the little worries that had been bubbling under the surface about AI.
And wow, the market did not like what it saw. The reaction was immediate and it was brutal. Oracle's stock just plummeted, dropping more than 10%. When you see a number that big, you know investors are genuinely spooked.
So what was in that report that caused such a panic? Well, it was kind of like a 1-2-3 punch. First off, they missed their cloud revenue targets. Not great. Then they announced they're going to spend a mind-boggling $50 billion by 2026 on AI stuff. So you put those two together, and it just sparked this massive fear across the market, asking, what if the cost to build all this AI is just insane? And the profits, well, they're nowhere in sight yet. And look, this wasn't just an Oracle problem. It was a sign of a much bigger shift in thinking. And the legendary investor Howard Marks, man, he put it perfectly. He said the market is starting to get way smarter. It's not enough to just have a cool AI story anymore. You have to actually make money. He calls AI a productive bubble, which is interesting. But he warns that even inside a bubble, if your finances are weak, you're going to get punished, period. But, okay, just as tech was taking it on the chin, this other, even more powerful force swooped in to save the day for the rest of the market. And that was the Fed's safety net. So what exactly did the Fed do? Oh, they basically gave the market a big old gift basket of everything it loves. They cut interest rates, they announced they're going to start buying up short-term bonds, which is just code for pumping more cash into the system, and they did all this while pointing to a weakening job market as their reason. All of this makes money cheaper, and it's a huge signal to investors that, hey, don't worry, we've got your back.
And you can see the effect this had on market psychology almost instantly. This chart shows the VIX, the market's so-called fear gauge, and look at that. It dropped 4%, falling below 15. The second the Fed started talking, it was like a wave of relief just washed over the entire market.
And the Fed wasn't just winging it. Their cautious stance was completely backed up by the data. We saw new jobless claims jump up to 236,000, which was way higher than anyone was expecting. This pretty much gave the Fed the perfect excuse they needed to justify these market-friendly moves. Okay, so you've got these two giant forces in a tug of war, right? The AI fears are pulling tech down, but the Fed's support is lifting everything else up. So what happens? Well, investors didn't panic and sell everything. Nope. They just moved their money around. They left one room and went into another. And this, my friends, is what we call the Great Sector Rotation. And this slide lays it out perfectly. It shows you exactly where that money flowed. On one side, you have communication services, which is chock full of those AI tech stocks. It was the day's biggest loser, down 1%. And where did the money go? All the way over to the materials sector, a classic old-school part of the economy. It was the biggest winner, up over 2%. Money just poured out of pricey tech and right into these cheaper companies that are more tied to the economy's health.
All right, so the big question is, what does this all mean for you, for the average investor? This kind of split market really creates two very different paths you could take. Let's walk through them.
Think of it like a fork in the road. On one side, you've got the aggressive approach. This is for people who think the AI sell-off is a total overreaction. The strategy here is to buy the dip in the best of the best AI companies, betting that they'll win out in the long run. The big risk, of course, is what if it takes way longer for them to get profitable than anyone thinks? Then there's the other path, the more stable route. This is where you follow the money into those cyclical stocks and smaller companies that tend to do great when interest rates are low. The risk here? If the economy really does slow down sharply, their earnings could get hit hard anyway. And of course, the market is never just about one single thing, right? There was other big news moving stocks too. You had Broadcom absolutely soaring after hours because their AI chip sales were fantastic, proving that the AI story is far from dead. Eli Lilly had a great day after positive results for its new weight loss drug. And then there was Disney, making a huge move by investing $1 billion in OpenAI. I mean, that shows you that the big players are still making massive bets on AI's future.
So all of this leaves us with the million-dollar question, doesn't it? Was today just a little blip on the radar, a temporary reality check in the unstoppable march of AI? Or are we seeing the beginning of something much bigger? A smarter, more disciplined era of investing where it's not just about the hype, but about the profits? You know, the answer to that question is probably going to decide where this market goes next.